Hi, good day to every one of you. I'm Kumar from Learn with Kumar and Cherry Academy. I'm a Cima professional tutor. I've been tutoring for the last 15 years or so. And today I thought I will make a little video presentation on our Cima case study for August 2021. It's all about Arrfield, the airport company. So I've done a little bit of ratio analysis, which I hope will be useful to anyone who will be sitting for the August exam. So this is your last exam as far as Cima career is concerned. So I hope that you all will put your very best and do it. And if you need any support from me, in whatever the way, you can WhatsApp to me, +9477 321 9387. +9477 321 9387. I'm Kumar from Learn with Kumar and from Cherry Academy. So this little presentation, which I'm going to start now, is all about the ratio analysis of our company, Arrfield, August 2021, the case study for Cima strategic case study. Right. Right. So one thing you need to remember, what we have got is a consolidated statement of financial position. So it's parent plus the subsidiaries together in that whole thing. So it's a consolidated statement of financial position what we have got. And whatever the ratios that I do it, it's based on the consolidated 3C. And also you need to remember these ratios what I done is as based on the financial statements of 31st December 2019 and 2020. By the time you sit for the exam, it is August 2021, almost 8 months have passed. So many of the figures in the financial statements could have got changed during this period. Of course, the examiner has told that ignore the COVID-19. Okay, even ignoring the COVID-19, 8 months is almost 2/3 of the year. So a lot of things would have happened. And therefore, we need to be mindful that we need to be looking at any updated information, they give it in the unseen before we sort of try to interpret any ratios or try to come to any conclusions based on what I'm going to do it just now. Right. So I want to look at the profitability ratio. So that's the operating margin, what we call, that is profit before interest and tax divided by the revenue. So we can see for 2020 for our company, Arrfield is 40.49. For our competitor company, Skyline, it's about 42.26, which means what it means is for every $100 of revenue, we generate an operating margin of $40. In other words, we are spending $60. Skyline is spending little lower. I mean, they're spending about $58. So slightly they are okay in cost control compared to us. The operating margin basically indicates how good we are in our cost control. In the airport industry, the ratio is around 40 or above. So we are generally within the ratio line. One thing we need to remember is that when you look at the two companies, our revenue is 10.395 billion, whereas the company Skyline is 3.395 billion. So in terms of sizes, it's about, we are about 3.1 times larger than the Skyline. So we are not ideally comparing apples with apples, but however, it's both in the same industry, but we need to be mindful. So I was just looking at if we can come to that Skyline profit margin of 42%, that's another 2% improvement over our figure, which can make another 208 million additional profit for us. So that's something which we need to look at, and that's the conclusion that I could get it from this ratio analysis. Right. Profit before tax margin. Now you can see a huge drop. So earlier, we looked at profit before interest and taxes, or profit before finance charges and taxes. Now, profit before tax. So from 40.49, it drops to 16.91. Even Skyline, there's a big drop. So what is that meaning? It is indicating that the finance cost is a huge component. I mean, we are paying 23.49, almost about 1/4 of our revenue is paid as finance charges. Now, that's a bit of a scary news in a way. Of course, there's the advantage of we are paid, we can claim for tax purposes. But if the economy turns into a downturn situation, we might find it very difficult. If there's a 25% drop in our sales, that can have such an impact upon our finance charges. So it's a huge component of finance charges, what we are paying out of our revenue. So we are heavily, as far as the expenditure is concerned, there's a huge finance expenditure. Later on, I'll come to this to talk about the effective rate of interest. But for the moment, you can see a drop in revenue could make a huge difference as far as our profits are concerned. Dear students, airport industry is never a dying industry, but it can go through economic shocks, like what we are going through today at this moment of time with COVID-19. But no airport can ever be kept for closed, because the airport is the gateway to the economy of any country. So it will go through temporary short economic shocks, but it will rise up again. That's why this airport industry, the payback period is a very long payback period, roughly about 20 to 22 years or maybe 25 years, kind of long-term payback, very solid base of assets. So you do have an asset base, and it's an industry that will keep on moving forward, but will be subject to temporary economic shocks, like what we saw in 11th of September, terrorist attacks in many countries, all that kind of thing. Having said that, one, we can say, again, we can say Skyline is slightly better than us, but we need to be mindful we are 3 times over them as far as the revenues are concerned. Yes, we need to look at from that angle also. Right. So the return on capital employed is comparatively low, understandable, because it's heavily asset-based industry. So we do have 6.45% return. In other words, for every $100 of capital employed, it generates a return of $6 or $6.45. For the providers of finance, I gone by book figures, because we don't have the market figures. Even though the market share price is given, we don't know the number of shares, so we can't work out the market capitalization. If you put up the market figures, these figures will be very, very low. It will be very, very low on return on capital employed. It indicates the high capital intensity of the business, solid asset base. So you can never lose in airport industry, I mean, on the long term, but you can have temporary shocks coming up in the airport industry. The share prices can be somewhat vulnerable in that sense, in the medium term, short term kind of thing. Asset turnover is the revenue that you earn for every dollar of capital employed. We can see it's very, very low, both the companies. So it seems to be sort of the norm of the industry. 0.159 for $1 of capital employed, revenue is 0.159, very low. So it's a very, very high capital industry, capital intensified industry. Skyline, again, we can see they are slightly better than us. In fact, their ratio has improved very much compared to last year. So their asset utilization seems to be much more better than ours. But both the companies seem to be having a very, very low asset turnover. Generally, we see asset turnover sometimes turning around 3 times, 4 times, but here it's turning at about 0.159. I mean, to recover your capital, at least it will need 8 times over this profit. So this is what we need to be mindful. And so these are the high capital intensified industries, which will indicate that the investors who are investing in these shares, they should be looking in terms of very, very long-term returns. So ideally, the investors should be pension funds, the fund managers kind of thing. Very unlikely the normal individual shareholder will want to invest because the returns are very low in the short term. Liquidity ratios, current assets to current liability, fairly comfortable. We can see Skyline, which was 5.19, has brought down. Now, one might argue that traditionally we thought the current assets to current liability should be 2:1, but now it's a different thinking now. We don't want to have too much of money tied up in working capital. So we can see how the Skyline has dropped it. Their trade receivables and their cash balances have dropped drastically. And therefore, they have, in a way, I would say it's an improvement in the working capital. Because today in the modern business world, we must have sufficient funds to sort of to liquidate our current liability, but not should have too much of money, because every dollar we invest in working capital, it's not going to generate any revenue for us. Every dollar we invest in non-current assets should be generating revenue. So having a fairly low current assets to current liabilities, so long as it is not too dangerous, it should be all right. And I can see Skyline has done a massive improvement. Anyway, we were our ratio was always lower. Slightly it has gone up, our ratio. So that's the scenario as far as liquidity is concerned. Now, this is a very, very interesting slide. Capital structure, the gearing. So again, I've gone by the book value of debt and liability and equity. As far as Arrfield is concerned, 28.68% of money has come from outsiders or interest-bearing capital, whereas in Skyline it is 50.4. So if you think in terms of financial risk, if you remember, the beta is, I think in our company it was beta, if I remember, it was about 1.5. So beta means it has both the financial risk and business risk. Financial risk is gearing. So our financial risk is lower, 28.68, whereas these people, financial risk is higher. So we know higher the gearing, higher the cost of equity. In fact, when the gearing is higher, according to the traditional capital structure, even the cost of debt will go up, should go up. So I would expect the cost of debt to be lower in our company, Arrfield, compared to Skyline. But let's look at, when you look at the next couple of slides, you will see that's not the story. So we need to understand that with low financial risk, our cost of debt, cost of equity should be lower than Skyline. But let's move on and see how the figures are going to look at. So we can see we have slightly improved it, rather not slightly improved, I mean, our gearing has slightly gone up, but Skyline gearing has come down. So we are still almost half of their gearing. So we have one thing, we have room for additional funding if there's a need. But when I come to that other slide, I'll explain. We need to be very mindful of the cost of finance. Interest cover is profit before finance charges divided by finance charges, which is very comfortable for both the companies, 1.72. In other words, what it says is we have enough profits in 2020 to pay our finance 1.72 times. In 2019, we had enough profits to pay our debt, interest, finance charges 1.65 times. So we can see Skyline is slightly better than us. It's all right, but we are all right as far as the interest cover is concerned. So far, no worries. But as I said, if the revenue comes down, If the profit comes down, it can be very dangerous at one point or the other. So we need to keep up our revenue push all the time, because with that high finance charge of 2,442 million, last time it was 2,344 million. So there's a slight drop, but still for all, it's a big amount of finance charges we are paying when we look at our profit. I think profit was something profit after tax was 1.6 or something like that. Now, this is the slide which I want every one of you to focus on. Look at the effective interest rate. What I did was I took the interest both the companies paid in 2020 and took the average loans between the opening and the closing as an average. You can see our rate is 13.48, whereas Skylane rate is 7.24. Now, with gearing being so low in our company, I would have expected it to be the other way about. Our cost of finance should have been lower. So this is something I think the examiner will test us in our case study. Why is this? With gearing being so low, why are we paying 13.48 interest rate effective 7.24? I mean, almost we are paying 50% more interest in terms of real outflows. Why should I pay that one? I mean, if I can save that one, it's about another 1.2 billion I could save, which can make my profit much more better, my return on equity much more better. So there's a big disparity. Something need to be looked at. I don't have any explanation. Maybe I'm thinking that Arrfield has gone for some fixed interest bearing loans, and we would have taken these loans early. Skylane would have gone for variable interest bearing loans, and their rates have come down, market rates have come down, and we are committed to a fixed interest. So in that case, we probably will need to think of going for an interest rate swap or something like that. Otherwise, we need to renegotiate all these facilities. Otherwise, borrow money, resettle these old loans. I mean, if Skylane can borrow it at 7.24 with a gearing of 50%, with our gearing of 28%, my rate should be much, much below. So probably poor financial management, poor financial thinking, something which you as the senior manager finance need to work hard on this. So this is a very, very interesting slide as far as this case study is concerned. Dividend cover again, very glaring figures. As far as Arrfield is concerned, we have paid almost 70% of 2020 profit as dividend, whereas Skylane is only paying 16% as dividend. They are keeping 84% almost as retained earnings, whereas we are paying 70% and a big dividend, 884 million in absolute terms, 79 million. We are just about 3 times bigger than them, but we are paying almost a 10 times bigger dividend. So we can see there is the two contrasting dividend policies being adopted in the two companies. Being listed companies, we need to be mindful. If we reduce the dividend, there can be signaling effect going to the market. So we need to be concerned about that one. But looking at Skylane, we can see they are paying a very low dividend. The reason being, maybe we are all right with our capital investments and therefore we can pay large dividends. But on the other hand, look at our vision. We want to be the best airport company. So if you want to be the best airport company, just having 6 airports in 3 countries, I don't think it's good enough. We need to go for more acquisitions, more takeovers. So we need money. So why we are paying big dividends? It may be the client will affect shareholder expectations, but something which we need to think about and rethink about our strategy. Be mindful of signaling effect to the market. Return on equity is very, very low. Even looking at the book figures, if you take the market figures, it may be very low. So we can see, again, Skylane is doing slightly better than us. And we could have done much more better if not for the high rate of interest we are paying, 13.48%. I mean, if we had that another 1.2 billion profit coming up, your ratio could have been much more attractive, much more better, because the equity people are the people who are taking the risk, and obviously their returns should be much more higher than the returns what we pay to the debt holders. But here we are paying a better return to the debt holders compared to the equity holders. So something is wrong in this financial structure, in the capital structure. Maybe, I don't know, maybe we can repay these high capital loans and go for equity fund. Of course, we might lose that tax advantage, but still it may be worthwhile, because paying to the lenders 13.48 and paying and giving a return of 3.15 on book values to the equity holders, I think it's not acceptable. Financial ratios, I worked out something for you all. Revenue, you can see that from 2019 to 2020, our growth is 5.26. Even Skylane, even though smaller revenue, still their growth is 5.26%. So probably the industry growth in our country in Holland is somewhere here, that range between the 2019 and 2020. So as I said, I'm Kumar from Learn with Kumar and Cherry Academy. And if you need any information, you can contact me on +94 77 321 9387 on WhatsApp. If you need any clarification, assistance, you can contact me. Also, you can contact me at email. cherryacademylk@gmail.com. If you need any assistance on your mocks or whatever, Cima Blueprint is the guideline for all of you all for this exam. So we need to understand our core competencies, excellences, and we must excel in each of those competencies whenever we are answering. The 60 minutes must be properly time planned so that you don't go right in unnecessary things only to the very specific points. So we need to be very smart to plan the answer and do it. So if you need any support, any assistance, please contact me. We do have about another 1 month, more than 1 month for the exam. If you need any one-to-one online tuition via Zoom from any part of the world, you can contact me at very affordable rates. I will support you, and I'll ensure that you get through this exam in August 2021. Share price growth, if you look at the chart, 2016 it was $26, 2021 $27, hardly increase, just about 3.8% increase over a period of 5 years. Probably as far as Arrfield is concerned, they are paying 70%, just retaining 30%. So you can't expect too much of share growth in that one. In that case, our dividend payout need to be larger, and that is what probably they are doing. But again, the return on equity is very low. Main reason is we are paid very high cost of finance. That is something which we need to be mindful. So I worked out little comparative figures because I want you to understand, even though we are comparing the ratios, revenue-wise, we are 3.1 times bigger. Profit after tax-wise, we are 2.6 times bigger. Total assets-wise, we are 3.45 times bigger. Equity-wise, we are 5.01 times bigger. Dividend-wise, we are 11.18 times bigger. So we are not two companies are not really comparable in terms of sizes, but of course the same industry, in same country. So there's some kind of resemblance, but don't go one-to-one, because we need to know that the size of the economies, size of the operations also will have an impact upon your ratios. So once again, I want to thank every one of you for watching this video. If you are happy, you can even subscribe to my YouTube channel. I've already put up a couple of YouTube presentations, one on business valuation, particularly applied to the airport industry. Then I did the industry analysis of the airport industry. And now this is all about the ratios. I will be putting more of these things in the days to come. And if you all need any assistance, please get me on +94 77 321 9387. +94 77 321 9387. So I'm Kumar signing off, wishing every one of you the very best the coming exams, and keep studying hard, try and write many more mocks. Doesn't matter who the provider is, look at any mocks, write it, do your answer planning, keep up to the Cima blueprint, and work hard and get through this exam, which will make such a big change in your career outlook once you get through this exam after sitting it in August 2021. Thank you very much, and God bless every one of you. So the revenue analysis also I done. Again, we can see it's a 5.27% growth over the 2 years. Aeronautical income is sort of slightly down compared to last year. Non-aeronautical has increased. So industry average was 56%, but we are getting 58%, and which is a good sign. So percentage of aeronautical total income is 58%. And last year it was 62%. So it's dropping. And that means the non-aeronautical is increasing, which is a good sign. Because the industry is 40%, but we are 42%. Because the future of the airport industry is the way that we increase the non-aeronautical income. Go to my industry analysis. I explained that one, why it is so important to improve the non-aeronautical income. So thank you once again, and God bless every one of you. Beta 1.15 indicates the systematic risk is 15% higher than the market. So obviously our shareholders would expect a return much more higher than the market going by the CAPM model. But we are not giving that kind of a return because the share appreciation is not too much. Dividend return is also not that high, even though the payout is very high. So I think the biggest concern for you and me will be the cost of debt. That should be the concern. Right. Cherry Academy. Our email is Cherry Academy, CHARRYACADEMYLK@gmail.com. You can send us an email, and me or my student coordinator or one of our tutors will help you with any of your queries. God bless every one of you. Thank you very much.